So if you've been trading Forex for a while, you probably think you know what a pip is. But let me tell you, when you jump over to gold, the rules of the game change just a little bit. And that slight difference, well, it can cost you some serious money if you're not careful. In this explainer, we're going to clear all that up. We're going to demystify how pips and lots actually work for gold so you can trade with total confidence.
All right, let's just tackle the big question right up front, the one that trips up so many traders. Is trading gold really the same as trading currencies? I mean, the charts kind of look the same, the price moves up and down, but the math happening behind the scenes, the thing that determines your profit and loss, it's fundamentally different. And not knowing those little distinctions, well, that can be a very expensive mistake.
Yeah, the short answer is not quite. And believe me, those seemingly tiny differences in how pips and lots get calculated can have a massive impact on your trading account. So let's break down exactly what you need to know, starting with the absolute smallest price move.
Okay, first up, let's talk about the smallest unit of price movement. You know, in Forex, we're all trained to look way out to that fourth decimal place, right? But with gold, it plays by a whole different set of rules. Understanding this one simple difference is really the foundation for everything else we're going to talk about.
Honestly, it's so much simpler than most currency pairs. For gold, a pip is just a change in the very first digit right after the decimal point. That's it. You can forget about the fourth or fifth decimal place. Let's look at a real-world example to make it crystal clear. So let's imagine the price of gold is moving. It goes from, say, $2,300.10 up to $2,300.20. We're just talking about a tiny 10-cent change in the price of 1 ounce. So what does that actually mean for your trade?
That 10-cent move is 1 pip. Simple as that. Now, you might see some brokers call this 10 points, where every single cent is a point. But for our purposes, the most important thing to remember is this. 1 pip is a 10-cent move. That's the key.
Okay, so we know a pip is 10 cents. Got it. But the real question is, how much money is that pip actually worth? Well, that depends entirely on your trade size, which brings us to our next critical piece of the puzzle, lot sizes. This is where we connect a small price movement to your actual bottom line.
You know, unlike a currency lot, which can feel a little abstract, a lot in gold trading has a very real, very tangible meaning. It directly corresponds to a specific amount of gold, measured in ounces. So when you place a trade, you're not just trading some number, you are actually controlling a certain amount of a physical commodity.
And here's how that breaks down. If you're trading a standard lot or a 1.00, you're trading 100 ounces of gold. So if the price moves just one single dollar, that's a $100 profit or loss. A mini lot, or 0.10, is 10 ounces, so that same $1 move is worth 10 bucks. And finally, a micro lot, just 0.01, is 1 ounce. So a $1 price move equals, you guessed it, $1 in your account. The lot size you choose directly scales your risk and your potential reward.
So, we've covered pips, we've covered lots. Let's put it all together now and boil it down to the essential takeaways you absolutely need to know before you place your next gold trade.
All right, to recap the core rules, let's burn these into your brain. 1 pip in gold is a 10-cent move. A standard lot makes a $1 price change worth $100. A micro lot makes that same $1 change worth just $1. You need to remember these numbers. But there's one really crucial catch you have to know about.
Now, this is incredibly important, so please listen up. While these numbers are pretty much the industry standard, they are not universal. Your specific broker might have slightly different rules. And just assuming every platform is exactly the same is a recipe for a really nasty surprise on a trade. So here's your homework. Before you even think about placing another gold trade, find the contract specification page or document on your broker's platform. It's going to tell you the exact lot sizes and pip values that they use. Seriously, take the 30 seconds to find and verify these numbers. It is the single smartest thing you can do to protect your capital.
And that brings us to the final and honestly the most important question. See, knowing the math is one thing, but truly understanding that a $10 move in the price of gold could mean a $1,000 swing in your account if you're trading a standard lot, well, that changes how you look at the chart, doesn't it? So now that you understand the numbers, take a hard look at your strategy. How are you going to manage that risk?